Chit Chat Stocks podcast, a podcast to help you find your next great investment. This is the Investing Power Hour live podcast recording. My name is Brett Schaefer, and instead of Ryan Henderson on the other mic today, we have recurring guest Travis Hoium from Asymmetric Investing. We're going to talk about what asymmetric investing is, talk about some of the asymmetric stocks that some of our listeners are interested in as well. But we're also going to be covering Tesla earnings, Netflix earnings, a little bit of bubble watch, which is an easy topic these days.
Is there a
A little
bubble
bit
going
of,
on? What's going on? Where's there a bubble?
yeah, it's a boom or a bubble. We're going to be talking about Google's position in AI, the update on the EV space. Travis covers GM, Rivian, and then Tesla as well. We have some asymmetric stocks, including MGM, HIMS and Hers, Duolingo, SoFi, and more. Before we get started, Travis, why don't you give an elevator pitch on what asymmetric investing is?
Asymmetric investing is my newsletter. I have a newsletter and a YouTube channel, but the newsletter is really kind of the core there. It's where I do all my research. Think about it as a little bit like my investing diary. So all the things that I'm thinking about. But the idea here is to find 10x stocks over the next 10 years. So I'm leaning into the advantages that we have over the market. A lot of the things that I focus on are rooted in strategy. What strategies work long term? Things like the smiling curve is something that I talk about on a regular basis. Aggregating demand, which is a concept Ben Thompson really pioneered. But those are the kinds of things you can look for that will lead to 10x returns over a long period of time. I'm not particularly interested in finding the rocket stocks that are going to, jump into meme status over the next few months. I'm more interested in what is the world going to look like 5, 10, 20 years from now, and riding those tailwinds, because that is a much more proven thesis. So I've got a portfolio there for paying subscribers, done pretty darn well. Beat the market by about 12% last year, and doing well again this year. I think we're up. What do we got today? About 45% on the year. So not too bad. Beating the market by 3x or so this year. So yeah, it's just full transparency into everything I'm doing in investing. And I think that's the way that we should all be doing it.
I agree. All right, one more question on that. We've had people, listening from the Motley Fool. We recently had David Gardner on for his new book. What would you say the similarities or differences is between, you've worked at the Motley Fool, written for them for a long time. What's the, you know, contrast between asymmetric investing and Motley Fool investing? Where does it overlap and where does it differ?
A lot of similarities to what David Gardner with rule breaker investing. What I've tried to do is, rule breakers was um, built at a time where you were just trying to find the companies that were literally breaking the rules. I think over time with the internet in particular, you've now seen, okay, what are the strategies that work? What are the things that, Amazon did or Netflix did to become the massive successful investments that they've been? And how can we replicate those? How can we see Spotify coming? That was the first company that I covered in spring of 2023. That was a really unloved stock at that time. I think shares are up about 600% since then. What are the through lines there that we can learn from history? So I'm kind of throwing a little less spaghetti at the wall and trying to be a little bit more precise, I would say. um, but generally the same kind of a thesis. So I'm looking for the companies that are going to be 10x 100x in returns, because those winners are going to drown out any losers that you have in the portfolio. And I've got a handful of losers, but they just simply don't matter when you look at the returns long term.
Yeah, I think what everyone needs to remember at the end of the day is no matter what type of investor you are, David Gardner, Warren Buffett style, Peter Lynch style, stock can only go down 100%, but it can go up 10x, 100x over the long term. And that's where almost all of your gains are going to be. All right, let's get into the topics today. I think I want to talk first, as usual, it's a company that people want to talk about. It's Tesla earnings, and this will lead into a broader EV discussion, which you cover quite closely. Let's just go through the numbers basically for anyone that hasn't seen them. Their auto revenues were up 6%. Gross profit was pretty much flat in the period. So they're seeing declining gross margins with increasing costs and decreasing sales prices. And their income from operations in the quarter was down 40%. That's not 4%. That's 40%. Other notes that I saw was that their market share continues to dip in Europe and China as a percentage of overall automotive sales. It recovered slightly in the United States, but I think that's probably almost entirely due to those expiring EV credits at the end of
Mhm.
September. Their operating income is at their lowest level in 4 years. Their EV to EBIT, which for any beginner listeners, that's similar to a PE ratio, that it's up to 300, which is definitely not cheap. First question I have for you, you see Musk talking about the humanoid robots, the AI, the cyber cab. Why? And I guess the leading question, because maybe listeners don't know that you're not a giant fan of Tesla. Why is this not an asymmetric stock?
Asymmetric investing is all about finding the opportunity at an appropriate price. And I think that's where I really struggle with Tesla. I actually wrote, you can go back in the archives when Tesla had about a market cap of about $2 billion. I wrote an article that said why I'm buying shares of Tesla. Um, the funny story behind that is we have these trading rules at the Motley Fool, and in those next 2 or 3 days, I think the stock shot up like 50%. And I was like, I'll just wait for it to come back down. Never came back down. So if you want to learn some from some of my mistakes, that would be a good one. But look, Tesla is already priced for perfection, and when you look at the EV market, I think that investors still think that it's 2019 or 2020, and it's not. The EV business is in decline. And it will be in stark decline in the fourth quarter. You mentioned, auto revenues were up 6%, but those margins are down. That means they didn't have any pricing power, even though there was a rush to buy EVs before that $7,500 tax credit ended at the end of September. So if you were going to buy an EV, you're going to do it in September, not October. That's going to hit Tesla more than it hits any other company. It's going to affect every other company out there. But that's the real headwind, is that their core business is not really at a point of strength. They're now at the point where their margins are pretty industry average, which I think a lot of us who followed the industry for a long time have never really understood how Tesla was going to. Remember when they were going to do a 25% gross margin, and everybody thought that that was what the way the world was going to work? That was never going to happen. But Musk was able to sell that story, and if you actually go back and look at the numbers, Tesla benefited dramatically from the dynamics during COVID. There was a ton of demand for vehicles, and most automakers screwed up their supply chains. And so that allowed Tesla to actually not only increase volume, but they raised prices at that same time. I periodically tweet out a chart that I've made just with their prices. I think you can do that on Fiscal AI too. But that's something that we can't overlook, is that they have actually been lowering the prices of their vehicles, and their volumes have been in decline. That's showing you that this is not a vehicle that's in very high demand. Then you look at something like FSD. Look, I've been critical of FSD for a very, very long time, because I don't think fundamentally it's going to be able to do the things that Musk thinks it's going to be able to do. And until he proves me wrong, that's going to be my opinion. Their launch in Austin has not been great. They've had to map all those areas. That's what he's been critical of. They've had incidents that any other automaker would be unacceptable. They even some of their incidents and accidents that they had to report. They basically got those like blacked out, so we can't actually see what they are. But even the things that people are recording while they're in the vehicles are troubling. And we're in a world where Waymo exists, where Mobileye has 100 plus Volkswagen ID buzzes driving around the US and Europe. I have May mobility vehicles. I'm in the Minneapolis area. We are not the first area to get autonomous vehicles, and there are May mobility vehicles driving around here. So where are they a leader? Where are they going to live up to this? Is a $1.3 trillion market cap today? You can go out and buy, we'll talk about some stocks later. You can go out and buy a stock for 10, a 10 price earnings multiple. What is Tesla going to do to get to the point where they're making $130 billion a year in net income? That's always something I look at, right? Like you can buy that value today. How is the company that you're buying that is priced more highly than that going to grow to that number and more? I just don't see it. I don't see it. There's no asymmetric investing is all about buying the company before it becomes the growth stock, not paying for growth that doesn't necessarily exist. That's where you get into trouble. So this is where asymmetric investing is really more value investing than you might think, because a lot of times it's not chasing these big trends that everybody's caught on to. It's buying into the trends before people figure out that that's what they are. I mean, that's why I like Mobileye. because it's a $10 billion company. It's possible that they're in 30 million vehicles in 10 years. That's a bigger upside than Tesla.
Yeah, if you look at just the autonomous vehicle space, it is getting to be hyper competitive. It's a lot
Yeah.
different than I think people thought 5, 10 years ago, where they said, oh, Tesla has this big lead. It could be a monopoly. That's really not turning out to be the case. And you can kind of see why Musk is pivoting to these. And I have no idea how likely they are to succeed, the humanoid robots and the AI stuff. But there's also the XAI, which is not even a part of Tesla. It's a whole complicated thing. And then we have this existing pay package proposal, which we could spend a whole show talking about how crazy that is.
So let me highlight where I do see an opportunity in this space, and hopefully this will sort of clarify what I mean by asymmetric investing. So Tesla has a $1.3 trillion market cap. It's not really clear that they're going to be able to do autonomy. They don't have the two-sided market of having the demand for like a robo cab today, but the companies that are existing ride sharing businesses, Uber and Lyft, are doing everything in their power to bring as much autonomous supply to their businesses as possible. Okay. So if that plays out and you have dozens of suppliers, so there's no real supplier power, the power is in owning the customer demand. So what do you choose? I would say this: what do people choose to interact with? So you're looking for a ride, you're looking for Uber or Lyft. Those two companies are in the asymmetric portfolio because I think the opportunity is in them still owning that point of demand, and then supply going from being human drivers to being autonomous vehicles. Then you expand your market potential by 10x, 100x. You open up a whole new another world. Lyft, which is one of those companies, I think this is one of my most asymmetric potential stocks. Lyft has a price to earnings multiple on a forward basis of 16. That's despite the fact that year to date shares are up 51%. So, when I was buying shares of Lyft, their price to earnings multiple was like 11. That's asymmetric potential, is if they take even a little bit of market share from Uber, and both Uber and Lyft are riding these massive tailwinds from autonomy. 10 years from now, this isn't an $8 billion company. It's a $80 billion company, or a $400 billion company. That's where you get that potential, is that you're paying a cheap price for a company that has bigger upside than a lot of people think.
Can we talk to close out the EV talk? Can we talk General Motors and Rivian? I know that General Motors had some very interesting things to say this quarter, and actually had, the company better. I didn't take a deep look at the quarter, but it seemed that they had very strong financial results.
Yeah, great results. I think they're managing the tariff stuff better than anybody thought. I think the revenue was actually up more than Tesla's was. Look, the money in vehicles is made in trucks and SUVs. That's, at the end of the day, the answer. They're in an interesting spot trying to figure out what their autonomy business is. They said they had $2 billion in revenue from their services, so Super Cruise and things like that, and they have $5 billion in deferred revenue. So when you buy a vehicle, you're kind of prepaying for I think it's 3 years of Super Cruise with some of their vehicles. That's gotten really good ratings. So it'll be interesting to see if they're able to make that into a real recurring revenue business. But again, you're paying, I think, 6 times earnings. So limited risk, upside potential if you get not only growth but margin expansion and multiple expansion. That's where the upside really comes from.
Okay, before we go to another topic, we have some in the comments here asking about the recent podcast I did on Subsea, or Kraken Robotics. The Subsea stock, they're asking if I still think it's a buy today. I will say during that episode, not to spoil what happened, I put it on my watch list because I thought it was overvalued, and now the stock's up 100% since then in the last few months. So I'm definitely still keeping it on the watch list. That's another example of there could be, I think it's a high potential business. I think it could 10x revenue over the next decade, but price matters, valuation matters, and I'm keeping it on the watch
Robotics
list
is going to
for
be one of
now.
these areas where if there is some sort of bubble burst over the next year or two or whatever it is, there's going to be a bunch of companies like this that
Yes.
just take it on the chin. And if you are watching them, this is where, watch list is important, because if you're watching them and you understand the business and you understand where the back the truck up moment is, that's where you get a real opportunity.
Yep, this is, I would think, and we're going to talk about bubbles later. This is not the time to have FOMO whatsoever.
Right.
Um, Okay, other topics. Well, do you want to talk Rivian at all, or the
Let's
electric vehicle
sure. Let's
space
do
in general?
Rivian.
What are they doing? They're pushing bikes. I haven't heard any of this at all.
Yeah, so Rivian, apparently as part of like a skunkworks project, they started making an electric bike. They have now launched, it looks almost like a Kickstarter. You can put, I think it's $50 down to reserve a bike. We don't actually, they don't give a lot of details about, when they're gonna be made or delivered and things like that. Rivian is such an interesting company because it's following in the tails of Tesla, who, was obviously a very successful investment for a lot of people. So a lot of people are kind of making a correlation between those two and not looking at the fact that Rivian has a ton of debt. They're burning cash like crazy. They really have no path to profitability. I mean, if you just look at where their capacity is, how much money they would have to make per vehicle, they'd need to make that 25% gross margin that Tesla said they could make. They've never done that. So it's so interesting to me that they are chasing around these strange shiny objects that don't help their fundamentals. Like they're building these beautiful showrooms and then selling 45,000 vehicles a year. That's just a completely unsustainable business. Again, one that should be in the asymmetric portfolio because it's a really interesting high potential business. I love the look of their vehicles. But from a practical standpoint, they just make so many silly errors.
Yeah, you can't invest in something on hope. You gotta look at the numbers
And this
and
is an auto business. Like
yeah.
you got to build a big manufacturing plant and then you got to run it. Like if you have never been in manufacturing, I worked in manufacturing for years for 3M, and it is a really hard business. And there's a reason that some of the businesses that are just here forever. Like you go to a manufacturing plant. I'm in the Midwest. They're running the same machines that they were running 50 years ago because they figured out how to do it, and there's no way to do it cheaper by with more robotics or anything like that. And they're highly automated, and it's really hard to appreciate that just like making a Chevy Tahoe is really hard, and GM just does it year after year, Ford does it year after year, and breaking into that space and trying to it's just it's a product that is really cool that's in a crazy price point. I think it's 70 or it's $4,500 for the bike. You can like go buy an e-bike for you know $1,200. Like why do you
Yeah, it's
I don't
kind
get
of
it. But
that reminds me of Peloton. That's the first thing I thought of when
as I have my Peloton sitting right here, I'll take the other side of
well,
that one.
I mean, maybe hey, the products are good, right? But from an investment standpoint,
Yeah.
the I think to before we move on to another topic, the one thing I'm just thinking about any electric vehicle company is these EV credits are going away, and anyone
Mhm.
that's a pure play, I feel like it's being underrated how much of a headwind this will be in the United States, not only to unit volumes but profitability.
Exactly. The pie is getting smaller.
Yeah, that's a good way to
The
put it.
and it was the case for a long time that the pie was getting bigger and Tesla was the only one taking a piece. Now you got everybody taking a piece and it's getting smaller. By the way, full disclosure, I do have a option short position in Rivian. So that is part of my special situations in the asymmetric portfolio. So
I like that, and I should say full disclosure, I'm short a big, I think 2 or 3 shares of Tesla
all
stock.
right.
So, small position there that hasn't worked out so far, but, I think it's a lesson in never size up a short book too much, because as everyone's heard, the price can stay irrational longer than you can stay solvent.
Yep.
I wanna talk next Hims and Hers. It's a company we've looked at on Chit Chat Stocks before. I think it was in early 2023 or maybe early 2024, but we haven't looked at it in the last few quarters. There's been a bit of, unsurprisingly, controversy with this company. I guess my question, I'll just leave it open ended. What are you thinking about Hims and Hers stock today? Let me look up the share price. You might have a better,
48.26
yeah,
today. Yeah, look, I got to give you guys credit. Your episode on Hims and Hers is one of the things that made me look at it more deeply. And I think you came up with the
wonderful.
customer acquisition treadmill line. which I have used more and more since then.
Nice.
Look, I think this is one of those companies that if when you looked at it, it was before they came out with GLP-1s, because I did my spotlight on them, I think in April or May of 2024. Um, they did not come out with GLP-1s until June or July. Since then, it has become seen as a GLP-1 company. And that has never really been the case. It's never been, I think if you look at their entire trajectory, it's more about bringing access to markets where it makes more sense to do these things digitally, right? Like they started with their whole thing was they started with ED. There's a difficult conversation to have, not to mention all of the pain points of like having to schedule a doctor's appointment, having to go to the doctor, having to go to the pharmacy. Now you take all of that and you just make it digital with someone you're never going to see in person, and it's like that's great. That's great. We want we want access to things that we should be getting treated in an easier way. You could even have more information, right? Like I'm wearing a Garmin watch. If I take all this information that's coming from my Garmin watch and I give it to my doctor, they're going to be like, "What am I going to do with this?" They have no way to even do anything with that information. So I just think you look at what the future of medicine looks like, and I have 3 kids. I wrote a lot about the pain points of like just getting a stupid prescription is so, you got to take them into the doctor. We know it's an ear infection. It's an ear, like just, I just want the thing, but you got to take them in. They got to look at you. You got to wait. You're screaming in it. Then I got to go to the pharmacy. Okay. The front, I'm the only one that's open is the one that's down. Like it's all a mess. Can't this be easier? And there are very few companies that are trying to actually fundamentally do things differently. And that's really where I come down with Hims and Hers. They are fundamentally trying to do things differently. Are they pushing the envelope? Probably. Um, is it uncomfortable sometimes? Dealing with maybe they're going to get sued here or there. Sure, but look at Uber, right? Uber got sued by like every city they entered when they first launched. That's now what, 100 and something billion-dollar company. Um, the opportunities. This is how disruption works. It is uncomfortable. It is pushing the envelope. It is making pharmaceutical companies mad, doctors mad. When you see Eli Lilly suing companies like Hims and Hers, by the way, didn't actually sue Hims and Hers, but sued all the ones that are kind of like them.
Hmm. Okay.
That
I
tells
didn't
you
know that.
they're terrified of what they're doing. That's the only way that they maintain their power position. And so that's sort of a high level look at it. On a more granular level, the fact that they keep adding specialties. They recently added testosterone. They added menopause and perimenopause treatments on the Hers app. The long term story is this is going to be a place we're going to go for more and more treatments for more and more things. Started with ED, then went to hair loss, then we got weight loss, then we have testosterone and menopause. The next thing is longevity. I don't know exactly what they're going to do there, but that could potentially be a massive new market. Just think about all the things that they can expand into, that it would be easier to open up your Hims and Hers app rather than calling up a doctor. This is a multi-$100 billion potential business, and it's still got a market cap of $10 billion. Again, that's asymmetric investing right there. Like if I'm wrong, I lose everything that I put into it. But if I'm right, what is this company worth? $1 trillion? That's
Or at
100x from
least,
here.
yeah, or at least $100 billion, something like that. And
Yeah,
I will
yeah.
say you weren't,
If
you're not buying, or your initial investment was at a much lower price, if I remember correctly,
yeah,
than 48.
yeah. I
Yeah.
think my cost basis is something like 30 or something like that. Yeah,
Okay.
and I
And
bought I bought a number of times too. Yeah.
we have a comment here. Curious if you agree or disagree. From Simon, people don't understand the soft moat of a company like Hims. There's something to be said about a simple, easy process that addresses pain points, and I'll agree. If for I think people like both of us that do contract work for the Motley Fool, almost running your own business, you're not in the W-2 health insurance provided world. You realize that doing this health insurance stuff and any medical stuff yourself is not fun. And Hims and Hers improves on that significantly for things that a lot of people are looking to have just an easy solution in their day-to-day life.
Yeah, and Andrew Dudum answered a question. I think it was the first quarter conference call, but somebody asked about if they're looking at adding insurance as a payment option, and he said no, because so my wife has our insurance. She has a corporate job, but you still have a high deductible plan, right?
Yeah.
So you're still paying the exorbitant prices that the insurance company has negotiated with the doctor. And by the way, neither of those parties has an incentive to lower their costs because the insurance company can only make profit based on what it's spending. So if they have $100 in profit and they can only or $100 in revenue and they have to spend $80 to service medical costs, the only way to increase their profit is to spend $100 next year on those medical costs. Now they can make you know a little bit more. That's the way that the business works today, and nothing about the existing structure is about lowering costs and improving quality. And so Dudum basically said, look, if we're going to actually do something disruptive here, we can't live within the confines of the insurance structure. We can't do it because it becomes a whole big burden for us. It's a big burden for customers. Let's just do cash and be done with it.
I'm looking at a chart here on Fiscal AI right now. One of the KPR charts on number of subscribers. In 2020, they had
Mhm.
300,000 subscribers. The last 12 months, they've had, or that'd be the last quarter, they had 2.4 million. Growth was 60% annually from 2020 to the last 12 months. My question I have for you is what stops them from getting, say, 2030, 2029, something along those lines? What stops them from getting to 10 million, 12 million subscribers sometime in the next 5 to 10 years?
I mean, it could be a number of different things. Maybe the business isn't as sticky. Maybe there is a little bit of a customer acquisition treadmill. So you have something like we'll see what the data looks like. The GLP-1 stuff kind of muddled things over the past few quarters. So that's something to keep an eye on. As they expand their specialties, does that actually increase the amount of sales that they're going to have and subscribers that they're going to have? That's gonna be a good question.
All right. Let's see. Yeah, we had another comment here on margins. I guess what do you think the long-term margin potential is for Hims and Hers? Because I see, 80% gross margin, but there's a big question as they're kind of inflecting to profitability. Well, what can that bottom line operating margin, free cash flow, net income margin be?
Right. So the operating margin is going to be a lagging indicator. So what you're going to do when you're acquiring a customer, so Hims and Hers is going to be a much more direct to consumer customer acquisition funnel. So it's going to be something like an Instagram ad. So they spend money on an Instagram ad. Let's say they spend $100 on an Instagram ad where somebody actually clicks into the Hims and Hers app. Um, when do they get that profitability from that customer? It's going to be over time. So it's not going to be necessarily the first month. It's going to be, maybe your payback is 10 months or 12 months. So you're not really going to hit that profitability point until year two. This is why growth at a company like this, you actually are less profitable the faster you're growing, which is sort of counterintuitive. If they slowed down, Axon did this for a long time. They were spending basically every dollar that they possibly could to grow their sales. So you're signing these long-term contracts. They're not, Axon's signing a 10-year contract, but they're paying their salesperson today for signing this contract. And so it's the fact that their margins are going up over time, I think is a really good sign. And management has said that those operating margins should increase 1 to 3 percentage points annually, kind of for the foreseeable future. So let's say over the next 3, 4, 5 years. If that's the case, and this becomes an operating margin of 10% even, suddenly this is almost a value stock.
Yeah. Yeah, I agree. I mean, I get nervous about the regulatory stuff, but I am still kicking myself for not buying in the spring of 2023 because it's up 4 or 5x since then.
Well, the other thing on the regulatory stuff though that I think people need to keep in mind is if you're going to be disrupting any business, any market,
Like Uber,
you
Airbnb.
have you have to be pushing the envelope. And the regulatory piece is I think not as scary as a lot of people think. The compounding thing, like compounding. My son got a compounded treatment from the children's hospital here when he was like 4 months old. Like it happens at on a regular basis that people get compounded treatments. The way that they're doing it, the scale that they're doing it is not necessarily the way that that law was written. On the flip side, look, these pharmaceutical companies are gouging everybody for everything that they make. I spend $500 every 6 months on EpiPens. The medicine that's in that EpiPen is like $1. Like, who's right and who's wrong here? So we could kind of play that, regulatory who's gouging who game. I would rather be on the side of the company that's trying to disrupt the pharmaceutical companies, but that's just me.
It's a great point. I want to talk Google and Alphabet. We do have one comment here or question I think can be maybe an interesting one for both of us to answer. I'm going to revise it a little bit. Um, Maybe, and the person here is asking about a growth stock, but maybe we can say it's an asymmetric stock. What is an asymmetric stock that you have been buying recently? What's one that you think, valuation makes sense? It's one that's come on your radar that you've been adding to your portfolio. And I'll answer too for the audience.
Yeah, I think on holding, on running, as I've been calling them. I always hate the holding name. Um, it's just like they're such a phenomenal company. It's such a fashion is tough, but I live in a suburban environment. It's one of those things where like, what are the suburban moms buying? Like everybody's wearing on, so they're buying their husbands on. Price to earnings multiple on a forward basis is 30. They're do you know what their 3-year compound annual growth rate is?
I have no clue, but I'm gonna guess since you're saying it's gonna be high, I'm gonna guess 30%.
43%.
Oh, wow. That is impressive for, I mean, a shoe
And
company.
they're
That's
right,
great.
and they're crushing their own guidance. Again, just like we talked about with HIMS, when you're making a physical good like a shoe or a piece of apparel, it's really, really hard to grow at 30-40% a year and to be profitable, but they've done exactly that. And guess what they said about tariffs? We're just going to raise our prices.
Mm.
Like that's exactly what you want to hear from a company like that is we have so much pricing power that if we get screwed by tariffs, we're just going to pass it on. Because you know what? Crocs is not saying, I think, you may have thoughts on Crocs too. It's another stock that I own. Cheap, cheap, cheap stock, but no pricing power. You can't go from a, $30 Croc to a $60 Croc and still sell the same amount of volume. On is in a different story. They can just go, you know what? Instead of charging $200 for this pair of shoes, we're going to charge 220.
Yeah, it feels a little bit. I know that stock has suffered recently. Lululemon back in the day with their pricing power premium brand there. It's funny you mentioned Crocs because that was what my choice was going to be. It's the latest stock I've bought. I broke my never invest in apparel rule, and I just think it's incredibly cheap. I think 6 times EV to EBIT with the stock price under $80. I think listeners have heard my takes on the company, but when researching for you coming on this episode, I looked at some of the stock spotlights you've done. Saw you looked at Crocs back in 2023 and maybe more recently as well. What are your thoughts on that brand? That, I mean, objectively it looks cheap, but people get worried about fad, virality, and fashion trend risks.
Yeah, I I have not bought shares in a while, in part because I just don't know. Like their last quarter was kind of tough, and I think their guidance was really weak because they were a company that just kind of threw up their hands about tariffs, and I think that everybody in the supply chain is cutting back inventory, which ends up impacting a company like Crocs. So I'm really interested to see what they say this next quarter. The other thing is the the Hey Dude brand turnaround has been. I mean, I think when I wrote that, it was kind of like it looks like Hey Dude's bottoming, and they're going to be hitting an inflection point. And if Crocs is kind of the Crocs brand is kind of your rock to build on top of, then Hey Dude is kind of upside. And Hey Dude, Hey Dude has just continued to decline quarter after quarter after quarter. I don't know if that turns around. They have not gotten the Sydney Sweeney bump. Uh, I don't understand why, but I
I
don't
know if
know. I
American
struggle
Eagle
with
is
that
going to
one.
get that. Why can't Crocs shareholders?
Right,
I don't
right,
know.
exactly.
Well,
They were
I
first to
think
it.
though, yeah, I know with their marketing though, and I'm stealing a lot of this from who I think is phenomenal investor Trevor Scott over at Tidefall Capital when he did a short write up for I think his investor letter. on Crocs. He mentioned this. They're bringing back some of the really strong designers that left the company. There's actually someone that left to work on the Stanley drinkware brand. Actually,
Mm.
basically 10x the revenue with that one. And now they're back. They brought him back to Crocs. And then as well in various international markets as well as the United States. You mentioned Sydney Sweeney and other marketing brand or celebrities that are marketing the brand. You have huge influencers slash celebrities in China that are marketing the brand as well as India. I mean, I saw that their flagship influencer it's a Bollywood actress I'd never heard of. I don't even remember what her name is, but she has 50 million Instagram followers, and now she's wearing Crocs in a lot of her posts.
Yeah, all the all the pieces are in place. Now we just got to see it. So again, I'm not selling my Crocs. I like where your head's at. It is asymmetric potential, but yeah, they just never quite seem to do the thing.
Yeah, and it'll be an interesting one. People say it's kind of like hopefully Lilu's investment in Timberland back in the late 90s, early 2000s. That went up 7x, but it seems like a good risk reward to me. It's not one that I want to
Mm.
make my largest position just because I'm worried about the moat a little bit, but I mean, 6 times earnings feels like a good opportunity.
Would you rather have them buy back debt or stock? That's my other
Both,
question with that
both.
cash flow. Yeah, they've been doing a little bit of both, but the stock's so cheap that yeah,
I
you want to leave a
think
little leverage there.
I think they've reduced the leverage a bit.
Yeah.
So I think I'd rather do them stock right now. I think they have room to do a little bit of both, but I agree. It's a interesting question. I would hope the larger shareholders, such as Tidefall Capital, are asking management right now.
Yeah.
Let's talk Google slash Alphabet. You had an interesting topic here. Let's see. This is maybe provocative for people that are long Nvidia, Microsoft, and what have you. It's Google bludgeoning the competition. You're very optimistic on Google slash Alphabet in AI. I am as well. I think if Ryan's listening to this episode, he's a shareholder of Alphabet and this will be music to his ears. What are your thoughts here and why do you think they have the long-term competitive advantage in AI?
They invented a lot of the things that we're seeing now in AI. So they were ahead of the game, not only ahead of Nvidia building, some of the chips and the concepts behind the chips. I'm not an expert in that case, but they've been doing this for a very long time. Acquired DeepMind. I think a story came out recently that Elon Musk wanted to buy DeepMind, and Sergey Brin was just like, "No, we're gonna do it." I think we're starting to see now. You could make the argument when ChatGPT came out that they were kind of caught flat-footed. They're not the best product company. Look at we're in Google Docs. Eh, they they could have made that a little better sometime over the last 10 or 15 years. Um, but they're a phenomenal technology company. So when you look at their AI models, I mean, VO3 is just incredible. There's no way that I don't think there's any way that they're not a leader in image and video models going forward since they own YouTube. They can use all that as training data. Um, and then when you look at what's going on with AI, even just with things like ChatGPT, they don't make money yet and they don't have a way to make money. So when you look at what they're doing, I mean, this week they launched ChatGPT Atlas, a browser. I tried it out. I opened about 6 websites and I got 2 pop-ups to upgrade my ChatGPT to a pro version or
Mm.
whatever the version. What are they doing with that? Google owns Chrome. They're using all that data to make search smarter and to follow you all around the internet so they can serve you better ads and stuff like that. There's a business model behind it. OpenAI doesn't have a business model. So then you look at we're pouring all this money, Oracle's pouring money, Microsoft's pouring money into OpenAI for what? And I just think Google's in the position where they can, when I say bludgeon the competition with cash, they're going to be able to build out these data centers faster, bigger, with better chips, with more money than anybody else, and they don't have to generate a return, so they can undercut on prices. So if you think about the topic right now is rare earths, right? Like there's plenty of rare earths in the US. We could be doing all this stuff, but it's a pain in the butt. It's more expensive. The second, there's a company called Molycorp about a decade ago that went crazy because they were a rare earth company when a similar dynamic happened. Well, they said, hey, we're going to invest this money and start up this mine. Guess what China did? They just cut their prices so that that mine was completely underwater, and then they didn't build it out. And investors never got a return. Eventually investors in Oracle, in OpenAI, in all of these other companies are going to have to make money, and I don't know how they're going to do that, especially when you look at the company that owns the distribution, YouTube, Android, search. All of these products are all Google products. And then you look at the other thing I noted, they already own like 10 or 14% of Anthropic, which they're potentially going to sign another $10+ billion cloud deal with. Their cloud is growing at an insane rate, and I think they're winning. They're the new AWS of AI, and that is just underappreciated today. And by the way, YouTube is bigger than Netflix. Let's not forget about that. There's just so much going for them. It
I
seems like a no-brainer.
I agree. One note on OpenAI's new browser is that it's actually built with, you probably know this, built with Chrome's underlying
Yeah,
architecture. I think
Chrome
it's
is
called
open source.
Chromium, which is
Yeah.
most browsers are actually built on.
Yep.
So where are they actually innovating there?
Well,
Not
here's the other
exactly
funny thing is
sure.
I signed in because my OpenAI or ChatGPT account is through my Google account. So like
Yep.
downloading that browser and then signing in with my Google sign in was just a moment of irony to me, that I'm just like, who's who's really running the show here? It's still Google.
Yeah, it is interesting with the next few years. We could see Gemini is slowly taking market share on usage wise from ChatGPT. They're reducing their internal costs significantly, and they could keep driving down costs, as you're mentioning, try to make a lot of this stuff free, either through Google search or Gemini free tiers.
Mhm.
And they have the financial capacity to do that, especially because if you look at not just the Google search profits, but Google Cloud is now highly profitable. We've seen, and I'm looking at this chart from fiscal right now. It was doing $4 billion in revenue in 2017. Last 12 months, we're pretty much at 50 billion, and they're seeing a giant profit inflection to, I think, 20%
Mhm.
operating margins. You also have the Play Store. You also have plenty of other things out there that give them the cash to, invest $80 billion, I think is the number, into CapEx
I think
this
it's
year. It might be
85
70.
this year. And wasn't there a rumor this week it's going to be like 120 next year? We'll see what they say in their conference call. I think they're next week.
I
Um,
did, yeah, I think they are next week, and I did see that rumor as well. So who knows? We might get an update on that next week. But they have, yeah, all these advantages. I guess I don't have bets on either. I'm trying to just stay out of the AI game whatsoever as an investor. But if you had to invest on Alphabet versus the Microsoft, Nvidia, and Microsoft's a whole got a lot of different business, but Microsoft, Nvidia, OpenAI complex, and the Oracle complex, which they all seem to be intermingling together. At least Nvidia, Oracle, OpenAI, especially. And I know OpenAI is a private company, so you can't really invest. But I would much rather bet on Alphabet versus those stocks that also have earnings ratios that are about twice as high.
yeah, yeah. For some reason, I think it's the best position to end. It's the cheapest. The other thing to maybe end on is there was an interview that the guy from Semi Analysis did. I think it was Patrick O'Shaughnessy's podcast. But one of the things that he said in there was, um, if you're OpenAI, you basically have to do exactly what Sam Altman is doing right now. You have no choice. You can't stop, because if you look at the scaling laws, and their argument is, hey, the AI is just going to keep getting smarter and smarter and smarter. Well, the thing is, you have to build exponentially more compute for it to actually get that much smarter. So you have to keep dumping more and more money in. So ChatGPT or GPT-2 was, X level of smart. GPT, or he compared it to, maybe GPT-3 was like a sixth grader, a 6-year old. GPT-4 is like a junior high kid, and eventually we'll get to, like, have being PhD smart. Well, that PhD smart is going to be 100 times more capex and GPUs, or 1,000 times more. So you have to come up with that money before you actually build the thing that is that smart. So it's kind of like a house of cards, but you have to build it. If you're OpenAI, you have to keep churning forward. and you have to keep these valuations going up. And this is the problem with this is where you get to bubble territory is eventually the market overall says, wait, are we ever going to get our money back? Are we ever going to get a return out of this? And if the answer is no, and we start to see that the answer is no, then stuff starts falling off a cliff. And when I say Google can bludgeon the competition, they can invest all of the money that all these other tech companies are doing to build out OpenAI's infrastructure. And at the end of it, if they win, that's all that matters because they have a cash machine. As long as they aren't disrupted, they're going to come out in a much better position. And they eventually, if OpenAI says, oh, crap, we can't do $1 trillion of investment, it's got to be 100 billion. What does Google do? Maybe they keep going and they go, fine, we'll invest it. We'll build super intelligence, or maybe we won't. And then we'll save ourselves $100 billion a year. Whatever happens, it's a great outcome for Google.
Couldn't have said it better myself. Let's do Brett's bubble watch. Pretty easy one this week. I have we have a somewhat serious topic that I think leads into something that you wanted to talk on as well, the difference between bubbles versus, asymmetric stocks and what a bubble can look like when we have historical examples that some people have lived through that are still investing today and some people that, maybe starting investing haven't lived through any bubbles. But I want to talk about this report last night that has since been, I guess, corrected of potential investments from the United States government into the quantum computing startups. Here's a quote from the Wall Street Journal. Companies including IonQ, Rigetti Computing, and D-Wave Quantum are discussing the government becoming a shareholder as part of agreements to get funding earmarked for promising technology companies, according to people familiar with the matter. Other companies such as quantum computing and atom computing are considering similar arrangements. Say as a note, when it's people familiar with the matter, that source is almost always the company.
Yeah,
Just
exactly. It's
they
the
don't want to say
CEO.
anything. Yeah, and we got an update today on Thursday, October 23rd, and this is from Reuters, a U.S. Commerce official told Reuters in an emailed statement that the department is not currently negotiating with any of the companies. We saw, uh, I guess, the stocks zoom up today and then come back down. What are your thoughts on some of these type of thematic stocks? Because I know as writing for the Motley Fool, these are extremely popular companies.
Mhm.
There are people that are very, very bullish on the quote unquote quantum revolution, but we have 10, $20 billion market caps with zero revenue. So I want to tie this in and say thoughts on these plus the difference between, a bubble stock versus asymmetric growth stock that can actually have, a good risk reward for your portfolio.
Yeah, I mean that's the thing is this could potentially be really interesting technology, but what's the business model? One of the things that I write a lot about is business models, and what you find over time is the best technology doesn't win, the best business model wins. So there was a couple dozen search engines out there when Google came around. Guess what? They figured out they had maybe a little bit better technology, but they figured out how to make money a lot better than everybody else. That was how they survived the dot-com crash and all that stuff.
And
Um,
the distribution advantage, Chrome,
Well,
Gmail,
that
Google,
came later. That came
came
later,
later, I
but
guess a
but
little later,
even
yeah.
but
Yeah.
even back in the 90s, there was Ask Jeeves and there was all kinds of other websites. It was not Google owning everything. They built that over time, and it was because they had money. You can go back to like Chris Sacca talking about like we had so much money, we had to go buy data center. Like we didn't know what to do with it. They were buying dark fiber in the dot-com crash because they were like, okay, we got cash, and then here's a whole bunch of stuff we'll figure out what to do with it eventually. So, look, these are not real companies today, as far as like businesses go. These are speculative investments. I hate the term thematic investing because I think a lot of the things that I'm investing in are long term themes, if you will. But thematic investing has come to mean what's the next thing that's going to get particularly like the retail investor excited.
The meme,
What's the next meme? Yeah,
yeah,
what's the
target.
next meme? And that's just a really dangerous way to invest. It is. And if you got out in front of it, great, great. But Ionic, um, they've got a $20 billion market cap and they have $50 million in revenue. Uh, Their net income is negative $50 million or $500 million. Sorry. Uh, what are you actually getting there? And what I have learned, again, I'm an old man in investing, but you could have sat out all of the 1990s, just sat it out and waited until 2001 or 2002 and said, who's going to actually survive here? You could
Who's got an
even wait
interesting
until
business model? Yeah.
who survived the crash. Okay. Amazon survived the crash. Pets.com did not survive the crash. Google didn't come public till 2004. Facebook wasn't started until 2004. There's the concept of the Gartner hype cycle. It's real, man. It's real. We're in the hype cycle for a lot of different technologies right now. But what's sustainable? And we're not going to know for until we go through a crash. And just think about these companies, like if they couldn't sell stock to fund their operations for the next 5 years, what are they going to do?
Good point. Good
They'd all be
point.
out of
Yeah, and
business.
that's how I look at it as well, where instead of saying, "All right, I'm gonna bet on whether this is going to be a revolutionary company, grow 100% year over year, what have you, today versus an extreme price," I'd rather figure out or wait for a potential bubble popping or not over the next 5 years, find a better entry point. If that entry point doesn't show up, that's fine. I got better stocks to own in my portfolio, but I don't want to take that risk today. I'd rather just stay patient and wait for the opportunity, whether it shows up or not.
And this is the thing that's so hard when the headlines are all about things like quantum computing, is just making the smart long-term decision is often what leads to the 10x returns, right? Like you look at just buy Chipotle in 2012. They make good burritos, people like them. It's a simple story. Google for 18 times earnings, where I was buying it a few months ago. It's not sexy. It's not gonna, but we're up 50% since then.
Yep.
You do that, you find a stock like that and you hold it for the next 10, 20 years, you're gonna do really well. It's gonna be boring at times, but that's how you find great investments, is taking that longer term view and understanding, where is this company actually going to be in 5 years. If you know where Ionic is going to be in 5 years or Rigetti is going to be in 5 years, great. I have
I
no
don't.
idea. I have no idea.
I,
And I don't think, they can't even. Rigetti also made some comments I saw today. I think it was on CNBC, sort of threatening the government, saying, hey, if you're not going to fund us, we'll find somebody else that's going to. Like that.
well, who cares? What?
Yeah.
That doesn't matter.
Yeah. I don't, look, this is not Intel. This is not rare earths. This is
Yeah.
not, a industrial policy that we need to figure out so that we're not reliant on Taiwan or China. So it's very different when you look at something like a government investment. And yeah, I don't know why they're even in a discussion, to be honest.
And you already have Google, Microsoft, and the other big tech companies investing what I'm assuming is probably $1 billion, at least hundreds of millions of dollars a year into these technologies. We already got plenty of scientists working on
Right.
it.
Right. And yeah, all these companies, Google's came out with something yesterday. And I was like, I don't understand what this means, but it's cool.
They're making more progress. Okay, we have just over 5 minutes. We have time for maybe one, potentially two other stocks to cover. Since you're the guest, I'm going to list off all the stocks we have on the list of potential ones to discuss, and you can choose which one you want to talk about. Netflix, MGM, Duolingo, SoFi. I'll toss in Robinhood as well. I know that's been a big winner for you. Or Celsius. Which one would you like to discuss?
All right, let's talk about one that I think sort of falls under, surprises people that it's in the asymmetric portfolio, MGM. Here's a classic example of phenomenal risk reward. If you Management has done this in a couple of conference calls recently. If you back out their ownership stake in China, which is actually publicly traded, so you can actually know what the value is. Their stake in their 50-50 stake in Bet MGM, which by the way just increased their own guidance, is going to pay MGM $100 million this year. So that's the online gaming business in the US. They own 50% of that.
Essentially, they get a dividend from this joint
Right.
venture up to them.
Right.
Okay.
Right. So they're not putting money in, but it's sort of like, what are you going to ever get out of that? Well, they're starting to get some cash now out of it. But just look at the core business. And that was trading for about 4 or 5 times EBITDA, which is a proxy for the cash that's coming from a casino. Because you spend a whole bunch of money to build a casino. What you want from that casino is earnings before you pay for interest, taxes, depreciation, amortization, and now rent. So that's a pretty cheap multiple. Um, Now, the upside is you got a little bit of growth in Las Vegas. I think Las Vegas is just going to kind of be steady as it goes. You got potential upside in Macau, but the real upside is online gaming, not priced in at all. So we got $100 million coming from that. What's that worth? $1 billion. They're right now a $9 billion company. Okay. So that's still not really valued by the stock at all. But the bigger thing is, okay, they're also buying back about 15% of their shares a year. Okay. So that's the other piece.
I have the chart pulled up for you right now. For any listeners, down 52% since 2017, 9.3% annual rate since then, and the stock's cheaper, so that 15% number makes sense. 566 million shares outstanding in 2017, only 272 million today. I mean,
So
that
buyback machine.
yeah.
But here's the real upside. Okay. So let's say over the next 5 years, they buy back another, I don't know, 40, 50% of their stock. Then they open up the one casino that's going to open in Japan. The only proxy for that casino is Marina Bay Sands in Singapore. Marina Bay Sands does about $2 billion. I think it's over $2 billion now in adjusted EBITDA. Japan is bigger, it is wealthier, there is more money going through that area. It is very possible that that is the most profitable building in the world when it opens, and you basically get it for free. I mean,
Yeah,
you
and
get
you
a
have, East Asia's huge gambling market, China, huge gambling market, and you would maybe think, and tell me if I'm thinking about this wrong, it has less of the Macau risk because of the China geopolitical
yeah,
potential risks out there. Is that part of the
right,
thesis
right.
maybe?
And to put the opportunity into perspective, Macau, which most people have either never heard of or definitely never been to, at a couple of years ago, it was 6 times the gambling revenue was 6 times that of the Las Vegas Strip. So Japan, we're talking about a similar market. I mean, pachinko. I had it in my update. I forget what the number, but pachinko is the one game that's sort of analogous in Japan, and it's massive, billions and billions. I forget if it's over $100 billion, but just a huge, huge market. So this should be a very, very big profitable casino. Uh, Management finally did. I've been making the Marina Bay Sands comparison for a long time. Management actually brought it up a quarter or two ago, so we'll see if that continues. But I think that's really underappreciated. Again, that's where you're buying a value stock, but what you're potentially getting is a growth stock. That's where you get 10x opportunities. Is okay. We're going to buy back shares, buy back shares, buy back shares. Oh, now we have this huge casino opening up, and we're going to not only have higher upside from a revenue perspective, but also multiple expansions. So you're maybe going from a 4 or 5 enterprise value to EBITDA multiple to 10, 15x. That's how you get those 10x returns in 10 years. It's not just, you know, rocket stocks. It's those just fundamental things over and over again.
Okay, 2 follow-ups before we get out of here. 1, what is the timeline in the Japanese casino? And 2, I
It
guess
should
there's an
open in
open
2030.
2030, okay. And second one, is Las Vegas dead? Because that's what people seem to be pricing in.
Yeah, I've been hearing that for 20 years. So yeah, I started covering casino stocks when I first started at the Motley Fool in 2010. You heard the same complaints then, the exact same complaints. You know, the drinks are too expensive, the games don't pay out what they used to. You know, entertainment
$10
is
blackjack minimum
ten
up to
dollar
15.
blackjack
Yeah.
minimum. Yeah, it's they're paying out five to 6 to 5 or whatever. Like all that stuff. Those complaints go back a long, long ways. People want Las Vegas to be Las Vegas of 1985. It's not. Um, if you go there, you're going to pay for what you get. But like, there's a lot of phenomenal things you can do for free. If you don't want to spend $30,000 at the blackjack table, then don't.
And it's more
Um,
entertainment focused now these days, right? With all the
Way more
sports coming
entertainment.
in, plus the
Yeah,
Sphere, all this new entertainment, not just gambling.
and you see all these criticisms, and you don't see any of the negativeness in the numbers. Like
Hmm.
the volatility in gaming there, the volatility even in visitation is just normal volatility at this point. And you had a boom coming out of COVID because it was kind of one of the areas where you could go like meet up with your buddies or your coworkers or whatever. then you have a little bit of a, okay, we did that in 2022. We don't need to do it
Right, little
again.
bullwhip.
And
Well, yeah.
yeah, but it's still one of the top 5 places to meet up with friends, to have a conference, to, have a business meeting, whatever. That's not going to change anytime soon. So I just think at City as you go, if you get it for a good price, I think that's a asymmetric opportunity still.
Yeah, and if the city does go into decline or MGM does go into decline, that's priced in. You're not going to lose that much, I wouldn't think. All right, I'm going to sneak this one in, even if we go a little long, because I think listeners are a lot of listeners probably have this one. What about the online competition for MGM from DraftKings, FanDuel, and others?
Um, I look at the online gaming business for MGM as just pure upside. So is there competition? Sure. We're not seeing that in the numbers negatively. Um, from MGM's perspective, I mentioned that they just increased their guidance for BetMGM. They're now going to be paying a dividend, so it's now a plus for MGM. That doesn't mean that DraftKings and FanDuel can't be successful. I've never understood. They have a really hard customer acquisition challenge because look, if you want to make money on this, like buy Disney stock because they're they're advertising all over the sports
Yeah.
networks.
Yep.
So I think that's the real challenge is they're on a customer acquisition treadmill, and the other threat is prediction markets.
I was going
Robin's
to
been a
mention
huge
that. I mean,
a
isn't
huge
MGM
boon for
more
Robinhood.
insulated than these other ones from prediction markets? Because you have the physical assets people want to go to.
Exactly, and that's why if you're I would not buy DraftKings stock, but I like having the optionality via MGM Resorts. I'm getting a cheap stock and I get upside if they figure something out. They've also got, online gaming in Brazil and countries like that. I don't know. I'm basically not paying for it. So I get it for free. Great. If there's some upside there. That's the way that I look at it. But that's where you kind of have to go. What's the risk reward? What are you paying for? And what are you potentially getting that's not priced in by the market? That's how you find those kind of opportunities. But yeah, their conference call after the BetMGM thing I think it was earlier this week or last week, was interesting because they were not happy about prediction markets and they don't think they're legal. But
We'll see.
CFTC
Hey, that could
says
be
they
your
are.
the disruptor, the HIMS and hers of that market coming in. But we'll see. All right, we're
Yeah.
going long. I'll let you get out of here, Travis. Thank you for subbing in for Ryan on this
Thanks for having me.
episode. And I'll put the links in the show notes. But again, tell people where they can find asymmetric investing.
Asymmetric Investing. I'm on YouTube. Also have a newsletter, asymmetric-investing.com. Also, I am now on autopilot as well. So we'll put a link to that in the show notes. That's where they have the Pelosi tracker. You can now track
All
the
right.
asymmetric portfolio. So pretty cool addition there.
Beautiful. Okay, let me hit the disclosure and we can get out of here. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in. We do these live every Thursday, typically 5 p.m. Eastern Time. This one was a little earlier to fit into Travis's schedule. But thank you guys once again. We'll go live next week, and we'll see you guys next time.